The promise of high returns and low risk has been a driver of separating people from their money for a very long time, and it's nothing new. And today we're going to be talking about is today's modern version of that, which is universal life. And we're going to be talking about Nelson Nash's opinion and point of view on this, and we're going to be sharing ours. So stick around.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're going to continue our journey of going through Nelson's Becoming Your Own Banker. And today we're going to be talking about creating the entity, and we're going to be sharing our thoughts and our opinions on, and Nelson's opinions on universal life. So hope you guys enjoy this episode. Anthony, as we kick this thing off, what are some of your thoughts as you started reading Creating the Entity?
Well, I would say it was interesting where he talks about creating the life insurance company. And I don't think we're going to go too much into detail on there.
Yeah.
I will say a couple highlights is that they're using actuarial science to determine their costs or their exposure. They add a little profit to it. Right. And these are over engineered, meaning that they overestimate the mortality and their expenses. And that's partly how we get the dividends. But then also dividends are reflected in some improvements in their investment returns. But in regards to the entity, what a couple things that I thought was interesting that Nelson had talked about here. And again, he'd mentioned we started talking about Social Security.
Yeah.
And in 1937, the life expectancy of a man was 61 years old.
Mm-hmm.
And they set the retirement age at 65. Okay, let me just reiterate that they set the retirement age 4 years past life expectancy. So Social Security wasn't made to be paying for a long retirement. It was actually a small piece of retirement. And now the life expectancy of a man is 75. But we still haven't changed the expectation of 65. So a couple of things Nelson's making, and I think what I would agree is we weren't built just to retire. I mean, retirement is defined as to take out of service. And the problem is those are some of our best years. Those are the years where we have the most wisdom and experience. And the worst thing we should do is just take that wisdom and experience and plop it in front of the TV. You know what? We need to be able to share that, whether it's either continuing to work or even volunteering. So Nelson had put in here, we should plan on really working until age 70. And then what I would say, even after age 70, we need some purpose.
Yeah.
And maybe that purpose is just working much less, or maybe it's volunteering, or maybe you've built some businesses and a real estate portfolio, and your job is you spend your time working on managing your investments. But also we do want to encourage you to share that wisdom, whether it's the next generation or with other people who are willing to learn. I encourage you to share your wisdom.
Well said. Yeah. I'm going to manage my portfolio and properties and play with the grandkids. Those are my two things.
Yeah.
I agree with you, man. One of the biggest statements, sentences that jumped out here to me when I was reading Creating the Entity, that first page, very similar. There wasn't much that was new there outside of the selection process, which I think sometimes people are surprised. And I think they're surprised when they get declined, to realize that not everybody gets accepted, right? So when you submit an application, they do go through an underwriting process, and not everyone is approved to be inside of that pool. And so that is one of the ways that they're able to mitigate their risk. The second sentence that really jumped out at me was really on page 37. Again, it said the most productive years are being wasted when people are assuming we're going to exit the workforce when we retire, right? And so I won't continue on that point. You hit a good topic there. But the one thing I do want to share with the listeners is the sentence that really kind of jumped out at me was at the bottom of page 36, and it said, "The coming debacle of Social Security is a natural result of operating from a faulty premise." Uh, Listeners, guys, listen, I am not a doomsday guy in any way whatsoever, but it got me thinking about the state of Social Security. And so one of the things I did is I actually jumped over and I did a little bit of research and I pulled up the annual report on the status of Social Security and Medicare programs. And so this is the report that the board publishes. It's public, it's out on their website, and I would urge you guys to go read it. I went through there, it's 25 pages. But there is some alarming stats that are shared, and I'm going to cherry pick and share these with you guys. So hang tight with me. But the purpose of me sharing this with you is really to reinforce what Nelson's saying here is Social Security is an absolute mess. And if you're depending upon Social Security to be there for you in any sort of way, I would say you need to reset kind of your goals. To Anthony's point, another stat that I had written down, he had shared that, man, when it first was initiated, it really wasn't supposed to be much support there, right? Because of life expectancy. A couple current stats right now is that half of current retirees count on Social Security for 50% of their income. Social Security makes up 60% of the wealth for a typical household held by someone between 55 and 64. And this one was scary to me. Without Social Security, 20 million Americans would descend into poverty. Scary stats right there. And this was another one that I pulled, but it talked about the strain that's being placed on the Social Security Trust Fund. And the COLA, the cost of living adjustments annually, are a huge strain. They're tied to inflation. And so they're jumping up. 2022 was 5.9 COLA increase, and 2023 was 8.7. So what you guys are going to see when we look at this report is that the timeline or expectancy of this fund is getting shorter and shorter and shorter, and those cost of living increases are not helping in any way whatsoever. So again, I appreciate you guys sticking around. Stick with me here. This is not going to be a happy ending when I go through this, but this was a message to the public. Again, this is a few notes from the summary of the 2024 annual report, Social Security. And it says, as in prior years, we found that the Social Security and Medicare programs both continue to face significant financing issues. Based upon our best estimates, the Old Age and Survivors Insurance Trust Fund, which is Social Security, will be able to pay 100% of total scheduled benefits until 2033. For you accountants out there, it's 2024. That's only 9 years away. At that time, the reserves funds will become depleted, and continuing program income will be sufficient to only pay 80%, 79% of scheduled benefits. That's wild. If the OASI Trust Fund projections are combined, the resulting projected fund would be able to pay 100% of total scheduled benefits until 2035. One note, as I was doing research, oftentimes they'll combine kind of the disability fund and the Social Security fund to prolong the expectancy of funds, which with a little research, you can find that that's actually against the law. They can't do that. So I thought that was interesting. The other one I wanted to share with you is we just talked about actuarial science, but another measure of the status of trust funds is called the actuarial balance. A negative balance is called an actuarial deficit and represents a shortfall in financing. A positive actuarial balance is called an actuarial surplus. The OASI have actuarial deficits over the next 75 years. They only measure 75 years as FASO, so that means that they are in trouble. The other one, the background, there's a few trust funds. I'll skip this here. We'll move along, but there's one other point that I did want to share with you guys. That's not it. It's going to be this one. How large are the asset reserves in the trust fund right now? At the end of 2023, Social Security asset reserves were $2,641 billion. And then it said, how did the program income compare to costs in 2023? In 2023, the OASI Trust Fund, Social Security cost of 1,237 billion exceeded income by $70 billion. So they lost $70 billion in this trust fund last year. That is a bleak outlook for the prospect of Social Security being there for you guys if or when we ever need it. So my advice to you guys there is do not count on Social Security benefits in any way being there for you. So
Great emphasis, Cameron. I would say, in my personal opinion, they're not going to get rid of Social Security. The too many of the taxpayers are dependent on it. Like
yeah,
we don't, our politicians don't have the cojones to make these difficult decisions. There will be something in there, but they're going to have to make changes to it. They're going to have to make cuts. But the bottom line, even though I think something will be there, I can't reiterate your point, is we should not be relying on it.
yeah.
That we need, first of all, do we really want to be relying on a government check to pay our bills? But there's a lot of things that you can do now to allow you to create that income and to create the life that you do want. And one attribute that can help you is with the infinite banking concept, which we're going through Nelson's book now. But if you have questions of infinite banking or how does it work, is it for you? Or maybe you got a policy and you're not sure if it's designed properly, get on a call with Cameron or I, 15-30 minutes, and let's kind of talk about how and if we can help. Link for that will be in the bio or the notes.
Well said. Fasto, let's dive into this. Page 37 is where he kind of introduces us to the illustration that's outlined on page 38.
Mm-hmm.
And he's talking about, he's putting insurance on a spectrum. And what he's doing with this spectrum is he's saying, hey, over here on the right-hand side, it's all death benefit. Over here on the left-hand side, it's all cash value. And he starts to make some differences between policy designs. And so I think this is a great time that we could bring up maybe some examples, pros and cons of different design features that are available. Anthony, you want to share a couple of examples?
Yeah. Well, I mean, one thing we can talk about is we can typically a whole life insurance policy you're paid premiums for your whole life, right? And typically, historically, that has been designed that you make premiums until you're 100 years old. But they also have what's called a short pay, where maybe you only make premiums for 10 years or 20 or to a certain age. And really what you're doing, you're kind of paying a higher premium to kind of to offset, the premiums that you're not making at the end of the pay. And what Nelson's talking about, which I thought was interesting, he says here that the shorter the payment period, the better suited it is for the purpose of the infinite banking concept. What are your thoughts on that, Cam?
I had that one circled as well. I had it circled and underlined and actually wrote an arrow next to it. I did want to discuss this. I actually would disagree a little bit here with Nelson, is that I've looked at short pay policies, and what I would say is, Nelson, when you look at it, yes, you do get better cash value in the short term, but you also need to take into consideration what you're giving up in the long run, right? And one of the things that you'll typically see is that there's no deals in life insurance. We've said that before. So if you're accelerating a policy for large cash value up front, to a certain extent, what you do is you give up some of the future growth later on. Additionally, the other thing that you're giving up is you're giving up future, what I would call capacity, or the ability to continue to pay premiums after a certain point. And so we've gone to think tanks, study groups, and there's some guys in there that are huge fans of 10 pays, right? Or maybe you only pay premium PUAs for 4 or 5 years and then you shut it off. I've seen those illustrations. I've designed them that way, but man, as I've grown in my career, I'm not a big fan of having hard stops on policies. I'm a much bigger fan of having more options. And so my tendency when I'm making illustrations is to leave the ability to continue funding open for as long as possible. And then if we need to, or we want the option of kind of discontinue premiums, we can do that. And so to have that statement to say the shorter the payment period, the better it's suited for infinite banking, man, I gotta disagree there.
I would too, and I will say I mean, we're strong believers of infinite banking, and Nelson Nash has been a great mentor. I will say we don't agree with 100% of the things that he does say. And man, I really wish he was still around. And I'd love to kind of have a discussion about to learn further of what he meant by that. And I would say there are some attributes, there's some advantages of a 10 pay or a shorter pay. Like you'd mentioned, there's going to be some um, earlier cash value. Also, and I don't know if this is good or bad, but you could only put premiums in for 10 years. So if you think premiums are bad or an expense and you want to stop them, then a short pay makes sense, right? But if you view your premiums as an asset, why would you want to handcuff yourself? And I could see that when somebody is presenting a policy with the short pay, to me, in my opinion, they don't fully believe in the power of life insurance. And they're really trying to focus on selling the cash value and selling the policies because those numbers will look a little better. Uh, but if somebody really understands infinite banking, they will be having a long term view. And one example that I can relate to, when I first got in this business, we were doing some term insurance.
Yeah, term riders.
Or even a rider, or typically, all right, let's get this whole life policy, but then let's get some convertible term that, for one, we can protect the family because the whole life we're designing it to minimize the death benefit, but also we can convert that term insurance into whole life when you're ready for your next policy. And I was continually recommending 10-year terms. Again, I was viewing term as an expense. We're not building any equity, and um, a 10-year term is going to be much less than a 15 or a 20-year term. So I thought I was doing what was best for my client. Then you fast forward 10 years, and now those clients, their 10-year term uh, has expired, and now instead of them being 35, they're now 45.
Mm-hmm.
And it's interesting. I just got the phone call with a client that we did the same thing, and his premiums have shot up. Not only is he older, we have a tendency to age as we get older, meaning we're not as healthy. So maybe we got that preferred plus when we're in our 30s, but we're in our 40s and 50s. Maybe we are standard. But I think that's an example where an agent is what we think is doing what we're doing right for the client. We need to have a long-term view, because after that 10 pay is done, what are you going to do with that premium? You're going to start another policy, but then every time we start another policy, we're having that slow start. So ideally, if we can design that first policy to continue funding, I think that's what's in the best interest for the client in the long run.
Yeah. When I look at this spectrum, I think what Nelson's trying to convey is that there is a spectrum, and most people aren't aware of it.
Mm-hmm.
Right? Most people are only presented with the option of insurance in regards to the death benefit. And I still remember one of the questions that I used to ask all the time was, after kind of introducing this spectrum to somebody, hey, there's death benefit over on this side, there's cash value on this side. I'd always ask them, is cash or death benefit more important to you? And then we'd ask them, right, is how many times a day have you thought about death benefit? How many times a day have you thought about cash, right?
Yeah.
And so it's framing, man, how important and how great this product is when it's designed appropriately. And that's what he's showing here by that mech line. The mech line, two things on that, right? It was introduced in the early 80s, and it's just kind of a ceiling or a cap on how much money somebody can put into a policy in one specific year.
Mm-hmm.
The IRS implemented that. What I appreciate with Nelson here is right at the top of page 38, first full sentence, he says, the mech line, it's not a matter of earth-shaking consequences, but it can be avoided with a little bit of understanding of what's going on. And again, I think I've shared this before, but I think a lot of times people use the mech line as kind of that boogeyman, right? That big scary thing. Guys, it's not all that scary, but we can do a few adjustments on the design to make sure that we don't hit that. And great visual, right? If you guys are driving, make sure you pull out Nelson's book and take a look at this. Ideally, we'd like to be on the far left side of this illustration for a maximum efficient contract.
Cameron, on that note, in regards to infinite banking, policy design is very important because the way we're designing it, we're trying to put as much money in as possible and get the lowest amount of death benefit. Where typically a typical or whole life design, or people think of life insurance, they're trying to get as much death benefit as possible for the smallest premium. And we're doing it the exact opposite. And the advantage of doing it this way is to be able to build up that cash value that you can leverage to finance assets and liabilities.
Yeah.
Another interesting thing, Cameron, that Nelson had put together, life insurance is like potatoes. Now, in the 1500s, the Spaniards came down to the Americas looking for gold. This section didn't necessarily find gold, but they found potatoes. And when they brought that back to Spain, the botanists had looked at it. They did properly label it as part of the Solanaceae family, which part of that family has some poisonous plants. So they were apprehensive to taking the potato. But that same family also produces some life-saving medicine. Eventually, they tried the potato, and it did the exact opposite. It didn't wasn't life-threatening. If anything, it was life-saving for what it did for Europe. What I think is interesting, life insurance can be very similar. Well, a lot of times people label it and they have these misconceptions that it's going to destroy your financial life, when if anything, when used properly, if anything, it's more like a medicine and can only improve your financial life. And a very interesting little data, 1 year's worth of potato of crops is worth more than all the gold that was found in the Western Hemisphere. So indirectly, the Spaniards found something more valuable than gold.
Well done on pronouncing the name.
I did Google it like a couple times.
It would have
I probably did it wrong too. But
I was gonna say it would have been fun to have like little taste tests. Like maybe we could have put some potatoes and maybe some of that Jimson weed, deadly nightshade. Have you just taste a few of those? see if you can tell the difference. That would have been fun.
I appreciate it.
Yeah, absolutely. Great point. Good stuff. All right, man. Let's if we don't have anything else to share on page 38, let's move over 39.
This is probably one of the most quoted pages that I quote.
And why would that be?
Well, it's interesting. It almost seems to go in waves with index universal life, or often called IULs, where it's super hot and exciting.
Yeah.
And that's typically when the stock market is doing well. But then when the stock market's not, people aren't talking about it. And so a lot of people will, can I just do more? Can I do infinite banking with a IUL? And there's even many people online that are promoting such a thing. But again, I wish Nelson was here and we could really get his be able to quote him. But however, we can quote in the book when what he talks about universal life, and this is what he says. I never sold one of these policies, and I would never buy one. I do not recommend this for the infinite banking concept. I think that's kind of enough. I mean,
it's pretty cut and dry.
We can reiterate and substantiate our opinion, But if anybody is telling you to do infinite banking with an IUL, first the question is, can you? You can use a lot of different products, and that's what he talks about in the section of financing a car. You could use a CD, you could use a bank account. There's a lot of different products that you can use. However, the best product is a whole life insurance policy, and an IUL should not be used. There's way too many risks and downsides on it, which I'm sure we'll probably discuss here today. Cam, what would you like to add?
Great section. Same. It kind of comes in waves as far as the popularity of it, right? When the market's good, right, people are really super high on this stuff, and when the market's bad, people are really super high on this stuff for whatever reason, right? So, universal life, variable life. One of the things that he also says in there is that, hey, the reason that he never sold one, the reason that he didn't personally own it, is because he went through and he did his own research, right? He started running illustrations and he looked at it, and they would explode or they would lapse, right, at later in life. And so he stayed away from it. So that's what I urge everybody is, man, do your own due diligence, right? Take a look at these things, but then compare it, right? Don't just take somebody's word for it for what they're telling you, because 9 times out of 10, when I talk to somebody about universal life, the first response is, they didn't tell me that. I'm like, well, I know they're not going to, right? So you got to do the research. You got to read the contract. Outside of this, man, we beat this universal life section up many, many times over the years, right in the front of our website, right? We've got a whole section that's devoted to it. If you guys have questions, go to the website, infinitewealthconsultants.com. Right up there in the top right, we've got a section on it says why we don't recommend IULs, and we've got a bunch of videos. Knock yourselves out, right? Go in there and watch those. We've got a lot of content that surrounds that. But one of the things that I did here is I was reading this section, I started looking at some of the names that he kind of quotes here. One of them was E.F. Hutton. One of them was, he mentioned Executive Life. The other one was Michael Milken. Man, I would urge you guys, if you're listening to this, next time you're in front of a computer, just Google search a few of these names and see what comes up. I went in and I Google searched E.F. Hutton. I knew kind of a general background of E.F. Hutton, and but I found something that I thought was very interesting that I wanted to share with you guys. This is just straight on Wikipedia. E.F. Hutton, he was an American stockbroker. He started American stock brokerage firm, and it was founded in 1904 by him and his brother. And so the scandal that I'm going to share with you guys is actually happened after he passed away, but there was a couple others that happened when he was still alive. He passed away in the early 60s, but I had no idea that this existed. But man, as you go through Wikipedia and you pull up his history and you look up kind of the history of the company, there was a huge check scandal in the 1980s that had to deal with the Hutton Company. I'm going to read you just a few excerpts, but it says, in 1980, several Hutton branches began writing checks which were greater than the cash they had on hand at the bank, then making a deposit into another bank equal to the amount it wrote in the first bank. It's called chaining, but this chaining gave Hutton the use of money in both accounts until the checks cleared. In effect, Hutton was giving itself a free loan that did not carry any interest. Over the years, Hutton shuffled money in this manner between 400 banks, gaining the use of an estimated $250 million a day without paying a penny of interest. Dang, right? This scheme went on for almost 3 years. In the spring of 1985, they got caught. They were going to trial. The defense attorney that they'd hired told Hutton's board that they faced 2 choices. One was to plead guilty to a massive list of felonies or face a trial that would likely see the 3 senior Hutton executives convicted and drive Hutton out of business. On May 2nd, 85, Hutton agreed to plead guilty to 2,000 counts of mail and wire fraud. And here's the punishment, Faso.
How many years prison did they get for check fraud?
Great. Prison, and listen to the amount of money that they paid, as well as a $2 million fine plus $750,000 for the cost of the investigation. In return, their defense attorney got 2 major concessions. One was no Hutton executives would be prosecuted. Second, they allowed Hutton, the company, to stay in business. Mind blowing, right? There's several more, right, in this list that goes on and on. But I jumped down. I also did some research on Executive Life and Fred Carr.
Cameron, before we dive
Yeah.
into that, let's reframe the importance of why he's talking about E.F. Hutton. E.F. Hutton, their firm is the one who designed the first universal life policy. So the company and the executive team that you just portrayed is the one who created universal life, which eventually morphed into indexed universal life. And I remember the commercials of E.F. Hutton. Do you?
No, I'm too young.
Yeah. It was, if E.F. Hutton talks, everybody listens. And I remember it'd be like a nice dinner or lunch, and E.F. Hutton would talk, and then everybody in the restaurant like pauses so they can hear what he's talking about. And now, Cameron, where is E.F. Hutton now?
He's dead now.
What?
Yeah.
How's the company?
The company, very interesting. Very company. After that, very interesting. After that happened, that was in the 80s. They stayed in business and they actually started merging. They merged with the Lehman Brothers.
Oh, very interesting. You know what else? I mean, we live in Las Vegas,
Yeah.
and so check writing or fraud is very severe. You can go to jail for writing a bad check in Las Vegas. And what these guys did, all of these, and received no zero jail time.
Zero jail time.
And their penalty was 2 million, or almost say 3.
2.75, right? And these guys had, were manufacturing, right? $250 million a day.
I guarantee you, by inflating that money, that they made way more
Absolutely.
than that $3 million.
Absolutely. Look up this next guy, Michael Milken, right? This junk bond guru.
I remember that too.
Yeah. He made a ton of money, goes to jail, comes out, and he's fine, right? No big deal. His net worth is still $6 billion. It's unreal. The last little bit I was going to share here was the same thing. Executive Life was a guy, Fred Carr. They called him a maverick genius. What he would do is he would go out and he would promise high returns with low risk and get people to give him money, and he would tell them he's investing in single premium deferred annuities. And so that's how he built this business, was promising high returns, low risk. Essentially, he was a thief. And that's really what he was doing. So again, you just kind of go through this whole list, and that was my takeaway after doing just a little bit of research of what Nelson's highlighting here is, man, that is nothing new. Those promises are out there now today. They're going to continue to be out there, right? And they're fraud, right? People are out there. That's how they separate us from our money, with this promise of high returns and low risk. And hey, you know what? You're not smart enough to do this, Anthony. Give me your money and let me go do it for you, right? It's the same thing that's being said out there today. And so I read this section and I take away kind of this word of caution is that, man, don't get duped by somebody out there promising huge returns. If they're asking you for your money, be very, very careful. The other thing that he kind of mentions is he references a couple of books. I haven't read two of these that he references, but one of them he talks about The Pirates of Manhattan by Barry James Dyke.
Mm-hmm.
Absolutely, hands down, one of my favorite books. I've read all three of his that he's written: Pirates of Manhattan 1, Pirates of Manhattan 2. If you guys have any questions on whether you should be investing in the market or whether you should be investing in kind of a mutual whole life insurance policy, Barry James Dyke, he goes deep in those books. And so absolutely give you a recommendation to read those. And the takeaway that you're going to have is you're going to have this whole idea that fraud is rampant kind of in the market, the stock market, even though there's all these governing bodies there. But yet you can always come back to kind of whole life insurance that is more of a partnership between the client and the insurance company. And that mutuality is really what perpetuates the success of these companies moving forward. So Really good book, man. I think he hits it at a very high level. If you take some time and dive into some of these books, I think you'll start to understand where he's coming from.
Well done, Cam.
Thanks. Anything else, Fasto? What do you got there? Anything else to share here?
Nope. I think one of the moral of the stories and what you had led with is be wary of the high returns, low risk, and that we need to learn what it is we're owning and what it is we're investing in. So we encourage you to do your own research and continue down reading Becoming Your Own Banker, because now we're going to start getting into some charts, I think, and start getting in some fun stuff with the numbers. So if you're new to this podcast, encourage you to go back to pick up part 1, and we look forward to helping you learn more about infinite banking and how that can help you achieve your goals with less time and less risk. Go make a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.